I'll send the recordings of in YouTube form soon. Okay, both English and
Okay, sir.
economics. Uh, so what shall we do today?
Today, we can do something.
Which one?
Economics, banking and credit.
Economics, banking, and credit. Yes. Lesson 15. Okay. Okay, I read this chapter. State banking and credit. Okay, so what do we know about the title banking and credit? We go to a bank to deposit money, withdraw money, right? Conduct certain transactions. And
Right,
what do we mean by credit? Credit is when the bank loans a person money, right?
right,
And it wants repayment and so on, right?
right,
So money and banking go together. So they're complementary to each other. Complementary means one depends on the other. So after studying money, we must study banking. A bank is a very important institution in modern society. Note that when society realized the benefits of using money as a medium of exchange, it also felt the need to store money in a safe place. So commonly what I read is they store money in a mattress or behind a hole in the plaster of the wall or more safely in the brick bag, right? So
right,
a bank is a place where money can be stored safely. This safe place, if safe place is put in inverted commas, because okay, ultimately evolved over time into a bank which deals with money in various ways. So in various ways, people make a visit to the bank for various purposes, such as to deposit their surplus money. Surplus means extra. So they keep what is necessary for them and deposit the rest in the bank. To withdraw money from their account in order to make payments in cash, to take a loan, etc. In the economy, banks play a very important role in facilitating the production, distribution, and business activities. So facilitating means they encourage by lending, okay? So they encourage production, distribution, and other business activities, okay? Banks,
okay,
okay? So 15.1 meaning of bank and banking. A bank is an institution which accepts money from public as deposits and gives loans to them. So banking refers to accepting for the purpose of lending or investment of deposits money from the public. So banks accept money, and from that money they lend some part of that money to the public, or they invest some of the money deposited, right? And
right,
some percentage of the deposit is payable on demand or otherwise and withdrawable by check, draft, order, etc. So the money can be withdrawn by means of a check, a demand draft, or money order, or in some other way. Nowadays, it's the UPI payments. You can withdraw money in form of UPI payments. So 15.2 functions of a bank from the meaning is given above. The functions of a bank are clearly understood. The primary functions of a bank are as follows. Accepting deposits from public, giving loans. So must keep that in mind. What is the function, primary function of a bank? Accepting deposits from public, giving loans. So pictures of logos of some bank, State Bank, SBI, Punjab National Bank, ICICI. Accepting deposits from public. A bank accepts monetary deposits from public, which includes individuals. So individuals can deposit money, groups. So something like you know groups of institutions, business firms, etc. So it should be noted that when somebody wants to deposit money in the bank accepts the money by opening an account in the name of the depositor. Right? So you have to fill in an account opening form. And the bank accepts the deposit to allot the account number to you. Okay. And the bank gives an account number to the depositor. Whenever the depositor wants to deposit money again, he or she has to mention the account number so that the bank that money that account. I think you know this. You must have opened an account, isn't it? Hello?
Yes, sir.
So anyway, these are the basics. So you have to keep these basics from which higher classes will build on. So the depositor withdraws money from his or her account, and the bank deducts the money from the depositor's account. So that's called debit, which is your account, and if you deposit money, it's called credit your account.
Right.
On the other hand, bank gives interest on certain types of if you are deposit to certain amount, certain deposit where you have to deposit some amount. Each type of deposit will earn a different amount of interest. So depending on the ability, it can deposit money for higher interest and so on. Note that the bank issues checkbooks to its depositors. Checks are used by the depositors to withdraw money from the bank and making payments to any party through the banking loans. The bank gives loans to public who want to borrow and who has a that's the bank will assist, it's called collateral. Like uh, bank must be sure that the borrower can repay the loan. So it will ask for 3 month salary slips, constant and income tax forms, that the income tax has been paid for a certain number of years, right? So that there is steady deposit and withdrawal of cash. So the bank must be sure that the loan will be repaid. So there are some conditions. So, uh, so they have to repay that loan amount in future. What does this mean? For this, we have to first know as to why people borrow. People borrow money because they want to buy something today or do some business for which there's not enough money with them at present. But they have the ability to repay the money in future. Goods such as television, refrigerator, washing machine, etc., are expensive items
Similarly, purchase or construction of house requires lots of money. For all these things, bank provides a loan. Bank also gives loan to start business, right? So there are different types of loans. There's housing loan, there's personal loan, there's vehicle loan, and there are also loans for starting a business, right? But in any case, the bank must be sure that you'll be able to repay the loan. So they may ask for something as security, or they may ask, if there's a salaried person that is been working regularly, and so the 3 months or 6 months salary slips with all the details like income amount deducted, and so when it gives a loan, depending on the income for a salaried person, it will give a loan up to a certain percentage. So if a person has an income of 55,000, the bank may give a loan of up to 35,000 as interest, right? Interest and principal combined. So there are various conditions, right? So anyway, keeping valuable materials. There is another function performed by a bank. The bank also keeps valuable things, people such as jewelry, property documents, etc. Normally, people want to keep valuables in safe custody, which is provided by the bank in the form of locker facility. Locker means it can be small locker, medium-sized locker, or large locker. The person who hires locker must to uh, have to. Oh, oh,
Yes, sir.
sorry, I got a bit of coughing.
Okay.
I think so. Okay. Anyway, in 1 minute, I'll be back in.
Okay, sir.
Hey, one ನಿಮಿಷ ಬನ್ನಿ ಬನ್ನಿ ಆಯ್ತು ಬನ್ನಿ bye. Okay. Okay. Are you still there, Ryan?
Yes, sir.
1 minute. So, brief interruption. So we'll continue, right?
Yeah,
Okay.
you can continue.
So that is a locker facility. So the person has to pay a certain amount of money in order to hire a locker. He keeps jewelry and other such valuable things, right? Text
Right.
questions 15.1. Name an institution in which someone can deposit surplus money. A bank is an institution in which someone can deposit surplus money. Name any two purposes for which a loan can be sanctioned by a bank. Loan can be sanctioned by a bank for purchase of vehicle or for starting a business, right? Uh,
Right.
so 15.3 meaning of credit. Credit is defined as a claim to receive payments. When a bank gives loans to people, then the bank becomes a lender, and the person who takes loan from the bank is called a borrower. When bank gives loan today, it also makes arrangements to recover the same from the person in future, right? So it makes arrangements, right? So, okay. Accordingly, the bank is able to expand its deposits. So once the loan is given, the borrower repays it little by little, and this the repayment is called an EMI. Usually, EMI means uh, earnest monthly deposit. Uh, EMI. So every month he has to pay a certain amount. That certain amount is made up of principal plus interest. So if the loan is low or high, the interest charge will be high, right? So
Right.
if a person takes a loan of, let's say, 5 lakhs, along with interest plus principal, he'll have to pay back 7.5 lakhs, right? So,
Right, sir.
so uh, anyway, uh, the what it means is the bank can claim the money from the borrower in future. Accordingly, the bank, so with that 2.5 lakhs, it's increased its deposit. Accordingly, the bank is able to expand its deposits. This is called credit creation by the bank. Okay, so it's called credit creation. So we can say that credit is created through the act of lending and borrowing. And it's also very useful because people can purchase many things like a vehicle, like a two-wheeler or a car, through installment schemes given by the bank, and he has to pay back a certain amount, and it's manageable. Whereas if it comes in form of one-time payment, then it will be difficult. So banks serve society in that way, and when they charge interest along with principal and recover the money, it is called credit creation by the bank. Okay?
Okay, sir.
So the process of credit creation. Now the following question arises: how does a bank create credit? Or to say, in other words, where does a bank arrange the money in order to give loan to others, and how much of loan or credit can it create? So how does the bank give loans? Where does it come from? We provide the answer below. We know that a bank accepts money from public as deposits. Normally, these deposits are supposed to be returned back to the public if they want to withdraw them. So suppose a person who deposits 10,000, then the bank must be able to, uh, um, you know, give the 10,000 back to the depositor when he demands it. So if all the persons who have deposited money in the bank withdraw their total money, then the bank will be left with no money at all. But such things normally do not happen. From common experience, it has been observed that once somebody deposits money in the bank, she doesn't withdraw it at once.
Yes, sir.
So if a person deposits 10,000 rupees, she doesn't withdraw on the full amount at once. Most people withdraw a smaller amount from the deposit whenever they require and leave the rest of the amount with the bank. To make this possible, the bank always keeps some fraction of its total deposits in the form of cash, from which it keeps giving money to people who come to withdraw it. So let's suppose one person deposits 10,000, another person deposits 20,000. Out of this 30,000, it will keep a fraction of the money, let's say 15,000, ready at hand to whenever the depositor comes to ask, it will keep 15,000 ready, and the other 15,000 it gives as loans, right? So this
Right, sir.
fraction is given in percentage term. So percentage can be 10%, 15% like that. So what percentage of the total deposit has to be kept as cash? So total deposit of all the depositors' money, how much percentage should be kept as cash? Well, this is decided by the banking authority of the country. So the banking authority of the country is the RBI, Reserve Bank of India. The cash amount is kept as reserve for making cash payments to public who come to the bank to withdraw money. We call the fraction of the total deposit to be kept in the form of cash reserve ratio, right? So this is the first technical term, cash reserve ratio, right? So what is the cash reserve ratio? We call the fraction of the total deposit to be kept in the form of cash as cash reserve ratio. Once the bank calculates the amount to be kept as cash on the basis of cash reserve ratio, it deducts the amount from the total deposits and uses the rest of the amount to give loans to the borrowers. With this act of the bank, the process of credit creation starts from here. Let us describe the process of credit creation step by step through the following example. Steps in credit creation to make things simple. Let us think that there's only one bank in the economy, that the banking authority decides that the cash reserve ratio is 20%. So the bank must keep 20% of its current deposits in the form of cash to make cash payments to persons who come to withdraw money. It's step 1. A person called A deposits 100 rupees in the bank. As a result, the bank's deposits increase by 100 rupees. As per the rule, the bank keeps 20% of 100 rupees as cash. This comes out to be 20 rupees. So the bank keeps 20 rupees to make cash payments. Now deduct 20 from 100. 100 minus 20 is 80. So the bank can use 80 rupees to give a loan. A person called B approaches the bank to take a loan of 80 rupees. After the bank gives this loan, it can claim the amount from B in future. This means that by giving loan to person B, the bank can create another deposit of 80 rupees. And so what it means is by giving 80 rupees, the person will repay that 80 rupees. So it's created another deposit of 80 rupees. Now let us calculate the total deposit with the bank. First, person A deposits 100 rupees. By giving loan to B, the bank is able to claim 80. So after the two steps, the bank has a total deposit of 180. So 100 rupees has become 180 rupees, right, with the bank.
Right.
So 100 plus 80 is equal to 180. Another person called C wants a loan from the bank. How much amount of money from the bank can the bank give as loan to C? In the previous step, we saw that the bank could increase its deposit by 80 rupees by claiming the amount B. As per rule, it has to give 20% of 80 rupees as cash before giving further loan to anybody. 20 rupees of 80 is 16. So the bank will keep 16 rupees as cash and give the rest of the amount. 80 minus 16, 64. The bank can give 64 as loan to C. Again, by claiming this amount from C, the bank can create another deposit of 64 in step 3. So total amount becomes 100 plus 80 plus 64, right?
Right.
So this is how the credit is created by the bank. Continuing from the previous two steps, we can say that after 3 steps, the total deposits with the bank is increased to 180 plus 64. 240 is equal to 244, or 180 plus 100 plus 80 plus 64 is equal to 244. So 100 has become 244 rupees, right?
Right.
So this chain will continue for some time, but when will it come to an end? You know that in each round the bank gives 20% of the increase in deposit as cash. You also know that the bank started an increase in its deposit by 100 rupees in step 1. So the process of credit creation or increase in deposits will come to an end when 20% of the deposits of each and every round taken together become 100, right? So, in itself, then the question 20% of what amount is 100? The answer is 20% of 500 is 100. This means that in our present example, the initial increase in the bank deposit by 100 rupees and cash reserve ratio of 20%, total credit creation will be 500 rupees. Okay, so that's the
Okay, sir.
maximum amount it can credit, it can create. There is a link among these three. 20% is equal to 20 by 100. So percentage means it's by 100. 20% means 20 by 100 is equal to 1 by 5. So 20 by 100 is 1 by 5. Here 500 is equal to 100 into 1 by 20%, 1 into 1 by 5. Okay. Accordingly, we can give the following formula for credit creation. Total credit is equal to initial increase in deposit into 1 by cash reserve ratio. So that is the formula. Total credit that can be created is the initial increase in deposit. Here it's 100 and into 1 by cash reserve ratio. So 1 by cash reserve ratio, 1 divided by 20%. 20% is 20 by 100, 1 by 20 by 100, 1 by 1 by 5. 5 comes to the numerator. 100 into 5 is equal to 500. Right? Did you follow
Right,
that?
sir. Yes, sir.
So 1 divided by 20%, 1 divided by 20 by 100, 1 divided by 1 by 5, 5 comes to the numerator. 100 into 5 is equal to 500. So that is the total credit. Also remember another important point, since the bank deposit is divided into 20% as cash and the rest as loan through various steps, the total deposit of 500 can be divided in the following manner. Cash reserve is 20% of 500 is equal to 100. Loan amount is equal to 500 minus 100 is equal to 400. Okay, so that's another way, that another step in dividing in allocating the cash, right? Now we can present the
Right.
various steps or rounds of credit creation in the following manner. Steps 1 to 5, increase in deposit is increase in deposit. Initially it's 100, cash reserve is 20, loan is 80, then it recovers at 80, increase in deposit becomes 80, cash reserve 20% of 80 is 16, and loan will become 64. That is recovered. So 64 is added to the increase in deposit. 20% of 64 is 12.8, and the loan that can be given is 51.2 rupees. 51.2 rupees is recovered. 20% of 51.2 is 10.24, is kept as cash reserve, and 51.2 minus 10.24 is 40.96. So 40.96 is recovered. 20% of 40.96 is 8.19, right? So loan is 40.96 minus 8.99 is 32.77, and this continues until the increase in deposit becomes 500, cash reserve becomes 100, and the loan becomes 400. Okay?
Okay, sir.
Finally, remember that in the process of credit creation, two types of deposits are recorded. The first one is called primary deposit. That's 100 rupees. Primary deposit is the initial increase in the bank deposit resulted when the bank receives a new deposit from the public. In our example given above, primary deposit is 100 rupees deposited by person A in the beginning. Second type of deposit is called secondary deposit. The deposits created due to loans given by the bank in each round are called secondary deposits. credit creation is possible due to increases in the secondary deposits, right?
Right.
What is credit creation capacity of a bank? The credit creation capacity of a bank depends on the cash reserve ratio. If the cash reserve ratio is higher, then the bank has to keep more cash to make payments to public, and accordingly fewer amounts will be available for giving loans. So less credit will be created. Credit creation will be higher if the cash reserve ratio is lower. So if the cash reserve ratio in the above example becomes 10%, then only 10 rupees has to be kept as in the bank and 90 rupees can be given as loan. So the amount of credit creation will be higher if the cash reserve ratio is lower, right?
Right.
In our above example, total credit was 500, given that the cash reserve ratio was 20% and initial increase in deposit was 100 rupees. Now decrease the cash reserve ratio to 10%. As a result, total credit will be 100 into 1 by 10%, that is 1 by 1 by 10. 100 into 10, that will be 1000. So total credit will become higher, it will become 1000, right? Okay, next index questions 15.2. The bank received a deposit of 200 rupees. It gave a loan of 180 rupees to a borrower. What is the cash reserve ratio? So you can do it like this, right? Uh,
Right.
200 rupees, right?
Right.
Now, if you make it 100, the loan will be 90. So it's 10%. Then 10 rupees is 10% of 100. So the cash reserve ratio is 20%. Check it, we'll see. 15.2, it's 10%. Uh, so, uh,
Yes, sir.
okay, so it is 10%. See, how will you calculate? Uh, so 20 rupees is no, it gave a loan of 180, so the cash deposit is 20. What is the cash reserve ratio? 20 is how much percentage of 200? It is 10%. Did you follow that? See, 200 rupees is the deposit. So it gave a loan of 180. So it has to keep 20 rupees. As now, when the depositor wants to withdraw it, has to keep 20 rupees. So 20, 200 by 20 is 10. So cash reserve ratio is 10%.
Yes, sir.
Okay. In our question, find out the amount of primary deposit, secondary deposit, and total deposit. So primary deposit is 200. Secondary deposit is 200 plus 180. That will become 380. So total deposit will be secondary deposit is 180. Total deposit will be is that right? Amount of primary in the above question. I'll work it out and send you the video. Okay.
Okay, sir.
Okay. So 15.5 various types of banks in India. In India, there are following types of banks: Reserve Bank of India, which is a central bank of a country; commercial banks; cooperative banks; development banks. Let us discuss them briefly. Reserve Bank of India, RBI. RBI is the head of the banking system in the country. This means that all other banks, such as commercial or cooperative or development banks, follow the rules and regulations made by RBI. Its headquarters are in Mumbai. RBI's main function is to issue currency notes. So all the currency notes in use today are issued by the RBI. The paper currency of various denominations such as 2 rupees. 2 rupees is not there, 5 rupees is not there, but 2 rupee coin, 5 rupee coin, 10 rupee coin, 50 rupee notes, 100 rupee notes, 500 rupee notes, and 1000. So this was written a long time ago, before demonetization of 2017. 1000 rupees is not there now, but even those were issued by the RBI, right?
Right.
You can see the signature of the governor of RBI on these currency notes. The note bearing the signature of the governor of RBI is approved by the government, so it can be used for buying and selling goods and services. 1 rupee notes and coins, as well as coins below 1 rupee, are issued by the Ministry of Finance, Government of India. 1 rupee notes and coins, as well as 50 paise coins, are issued by the Ministry of Finance, Government of India. Another function of RBI is that it acts as a banker to the government. So the government itself will deposit all its taxes and so on with the RBI. In India, both central and state governments take loan from RBI. And so if the metro, how was it built? It took a loan from the RBI, right? And the state governments and central governments deposit their money with the Reserve Bank of India. Okay.
Okay, sir.
So 15.5.2 commercial banks. Just now we were discussing credit creation. The bank which we were talking about, there was actually a commercial bank. The functions of a bank which we discussed earlier, also functions of a commercial bank. There are some commercial banks which are under the public sector. For example, State Bank of India, SBI, Punjab National Bank, Bank of India, Indian Bank, Canara Bank, Bank of Baroda, etc. There are other commercial banks which are under private sector, such as ICICI, Yes Bank, HDFC Bank. These banks are privately run, right? So they're all private banks. The aim of a commercial bank is to earn profit by charging rate of interest on loans and fees for various services such as issuing, draft, transferring money, etc. So DD, when it's taken, the bank takes a small percentage of the amount deposit demand, the amount involved in the DD as. So when it transfers money, issues demand drafts and so on, and gives loans, that is how it earns profit. So what is a cooperative bank? They may ask you this: what is the RBI? What is a commercial bank? What is a cooperative bank? Right?
Right.
So in India, there are many banks which are run by cooperative societies. Cooperative societies mean a group of farmers gets together and they open a bank. That's called a cooperative. Cooperative means people come together to conduct an activity and are governed by the laws of the state in which they are operating. So cooperative banks rules are determined by the state government. Such banks are of two types: agricultural or rural, and non-agricultural or urban. In rural areas, cooperative banks provide credit for farming, cattle, fishery, etc. In urban areas, cooperative banks provide credit for self-employment activities, small-scale industry, purchase of durable goods such as television, refrigerator, and personal finance. Right? So
Right.
examples of cooperative banks are state cooperative banks, primary agricultural credit societies, urban cooperative banks, land development banks, and district central cooperative banks. So those are the names of the various types of cooperative banks, and they have different functions. These banks may bear different names in different states and areas. So finally, development banks. To achieve economic development for the country, investment in industries and infrastructure is required. So to achieve economic development, industries, factories must be set up. To make such things possible, there are development banks in India. These banks provide credit for a long period to private business, companies, and public sector units who want to establish industries and create infrastructure. Infrastructure means roads, bridges, railways, like that. So they can create infrastructure. Some examples of development banks are Industrial Development Bank of India, IDBI, Industrial Financial Corporation of India, and State Finance Corporation, right? So finally, index questions 15.3. Give one example each of a commercial bank, cooperative bank, and development bank. One example of a commercial bank is SBI. Cooperative bank can be rural cooperative bank, and development bank example is uh, Industrial Development Bank of India. So second question, question 2. For which activities do the cooperative banks provide credit in rural and urban areas? So in rural areas, cooperative banks give loans for uh, farming, cattle, fishery, and so on. And in urban areas, the cooperative banks provide credit for self-employment, setting up of small-scale industry, purchase of durable goods, etc. Right? Which is the head of banking system in India? The Central Bank of India is the Reserve Bank of India. That is the head of the banking system in India. Okay?
Okay, sir.
So that is that. What you have learned, you can read that. Okay? Terminal exercises you'll do, right? You have to. Okay?
Okay, sir.
Okay, shall we stop there?
Yeah, we can stop there.
Okay, we'll continue tomorrow. Your mother asked me to take classes daily. So I'll send YouTube videos of the lessons as soon as possible. There are so many of them.
Yeah.
I'll create YouTube videos and send them all to you, both in English and economics
Okay.
side, and hope to label them properly so you'll be able to refer to them when needed. Okay?
Okay, sir.
Okay, bye. See you.
Bye. Thank you, sir.
Thank you.